After starting this module, we shall be able to understand the concept of exchange rates, distinguish between spot and forward exchange rates, outline the factors affecting exchange rate determination, distinguish between fixed and flexible exchange rate systems, know about the participants in foreign exchange markets, understand LERMS, that is, Liberalized Exchange Rate Management System in India, calculate exchange rate quotes.
A defining feature of the global economy in the last few decades has been increased flows of international trade and investment. Both these activities require the use of foreign exchange, such as dollars, euros, and pounds. This is because sellers in different countries want to be paid in their home currency or in a currency considered strong and universally acceptable. For example, an Indian exporter to the USA will earn dollars for his goods but will have to convert them into rupees for use in the domestic economy. And an Indian importer purchasing goods from Germany may have to convert Indian rupees into euros to pay his buyer. This requires a foreign exchange market where foreign currencies are traded. The foreign exchange market in any country is an essential component of the international monetary system. The institutional framework within which the international payments are made, national currencies are exchanged, and cross-currency exchange rates are determined. Cross-border transactions of trade and investment occur through an exchange of currencies between buyers and sellers. A currency is a form of money and a unit of exchange. Foreign exchange is the money of a foreign country in the form of banknotes, drafts, and checks. It is expressed as the foreign exchange rate, which is the price of domestic currency in terms of a foreign currency. For example, INR versus the US dollar or the INR versus the euro. In this module, we shall discuss the concept of exchange rates, the factors affecting exchange rate determination, the fixed and the flexible exchange rate systems, the participants in foreign exchange markets. We would also discuss the liberalized exchange rate management system in India with the help of visuals and animations.
Let us begin by understanding the concept of foreign exchange market. It is the market where currency of one country is traded for currency of another country. It is an over the counter market, which means that there is no physical marketplace where currencies are traded. Instead, it is a network of large commercial or investment banks, brokers, and dealers spread across the globe, connected through telephones, faxes, and computers. There are two segments of forex markets: spot market and forward market. Spot market. It is that segment of foreign exchange market where currencies are traded for immediate delivery. The day on which delivery takes place is known as value date or settlement date. The rate applicable to on the spot trades are known as spot exchange rates. Forward market. It is that segment of the foreign exchange market where currencies are traded not for immediate delivery but for delivery on any future date, say after a fortnight, 30 days, 90 days, and so on. The rate governing such future transactions is known as forward exchange rate. For most major currencies, forward exchange rates are quoted for 30 days, 90 days, and 120 days, and so on. These rates can be at premium or discount compared to the spot exchange rate. Forward exchanges provide a mechanism for eliminating exchange rate risk that may arise in future due to adverse movements in the exchange rate. There are three participants in foreign exchange market. Non-banking entities. These include importers, exporters, investors, and multinational corporations who participate in the market to settle their international transactions. Banking entities. These include commercial banks and central bank of the country. While commercial banks play the role of market maker and operate for profit motive, central bank plays the role of regulator in the market. Central bank aims to curb the excessive volatility in the exchange rates. Foreign exchange brokers. They play the role of mediator in the market. Their role is to bring buyers and sellers together. Let us now try to understand the concept of exchange rate. For a pair of currency, exchange rate is the price of one currency quoted in terms of another currency. It indicates the price at which one currency can be exchanged for another. The two ways of quoting exchange rates are direct quote and indirect quote. A direct quote is the quote where exchange rate is expressed in terms of number of units of domestic currency per unit of foreign currency. Rupees per dollar. For example, 55 is the direct quote for USD in India. This quote is read as rupees 55 per US dollar. In other words, $1 is worth rupees 55. Indirect quote is the quote where exchange rate is expressed in terms of number of units of foreign currency per unit of domestic currency. Dollar per rupees. For example, 0.0182 is the indirect quote for USD in India. This is to be read as $0.0182 per rupee. In other words, 1 rupee is worth $0.0182. Foreign exchange rate regime refers to set of policies, agreements, institutions, mechanisms, and rules for determination of exchange rate at a given point of time. Changes in exchange rate over time and factors inducing such changes. The type of exchange rate regime adopted by the country determines the involvement of government in establishing and maintaining the exchange rate of its domestic currency against foreign currencies. Depending on the involvement of government or monetary authorities of a country in foreign exchange market, exchange rate regimes are classified as fixed exchange rate system or flexible, that is floating exchange rate system. Let us now discuss the various types of fixed exchange rate systems. Currency board system. Under the system, currency board of the country fixes or pegs the rate of its domestic currency in terms of foreign currency. The foreign currency to which the domestic currency is pegged is known as anchor currency or reference currency. a strong and internationally traded foreign currency is selected as anchor currency by the currency board. In order to maintain the exchange rate at peg level, currency board attempts to keep the monetary policy of a country in line with monetary policy of reference country. It also ensures unrestricted conversion of domestic currency into the anchor currency at fixed rate on both current and capital account. Example: Argentina had currency board system until 2002. Argentina peso was pegged to US dollar. Dollarization. It is the system where the country abandons its domestic currency and instead uses any other currency, dollar or not, as the legal tender. Example: Ecuador and El Salvador are using US dollar as their legal tender since 2000 and 2001 respectively. Target zone arrangement. Under this, a group of countries agree to keep the exchange rate between their currencies within a certain range of fixed central exchange rate. Central exchange rate is the exchange rate between the member country's currency and a common currency. An example of target zone arrangement is European monetary system. Each currency in the EMS had a central rate expressed in terms of European currency unit, that is ECU. The exchange rate between member countries was determined on the basis of their share in the ECU. Another variant of target zone arrangement is the monetary union, where member countries agree to share a common currency instead of using their own currency. ECU has been substituted by common currency, euro, shared by 12 European countries since 1999. Currency basket. It is a system of pegging the currency or fixing the value of currency in terms of basket of foreign currencies instead of a single foreign currency. The value of currency basket peg is more stable than pegging to a single currency. Let us now move on to the concept of flexible exchange rate system. Under the system, the exchange rate is determined by the market forces of demand and supply of a currency in respect of a particular foreign currency. The exchange rate is neither determined nor administered by the government or the central bank. The two types of flexible, that is, floating exchange rate systems are free float. In a free float, exchange rate is determined purely by the market forces of demand and supply. There is no intervention either by the government or the central bank in the foreign exchange market. Variations in exchange rate occur as a result of reaction of market participants to a variety of factors including economic factors, social factors, and political factors. Free float markets are characterized by highly volatile exchange rates. Managed float. In a managed float also, exchange rates are determined by the market forces of demand and supply. Unlike in free float here, the government or the central bank occasionally intervenes in the foreign exchange market with the aim of smoothing out excess volatility and reducing uncertainty. Let us now discuss the factors that affect exchange rate determination. Exchange rate moves in line with changes in demand and supply of currency. The various factors that cause changes in demand and supply of currency and hence exchange rate are relative price levels, relative income level, interest rates, and market expectations. We shall now discuss how these factors affect the exchange rate determination in detail. Relative price level. Change in relative price level influences international trade pattern. Suppose inflation in India is higher than that in US. High inflation makes Indian goods costlier and reduces their demand both in India and abroad. Due to rise in prices in home country, Indians consume more imported goods than domestic goods. Hence, imports increases. Higher imports from US mean increased demand for USD. In the diagram, demand curve for USD shifts rightward from D1 to D2. At the same time, exports from India fall. This means foreigners do not need and hence do not buy Indian rupee, which implies that supply of USD in the market falls. Supply curve of USD shifts upward from S1 to S2. New exchange rate is determined at the intersection of D2 and S2. Exchange rate between INR and USD has changed from rupees 55 per dollar to rupees 58 per dollar. Hence, INR has depreciated against USD. Relative income level. Changes in income level influences purchasing power and hence the demand for domestic as well as imported goods. Suppose the level of income in India rises while the level of income in US is constant. Increase in income results in residents demanding more goods, domestic as well as imported. Increase in imports means increased demand for foreign currency, USD in this case. The demand for USD increases, demand curve shifts rightward from D1 to D2. Given the supply of dollars in the market, increased demand results in appreciation of USD. New exchange rate is determined by the intersection of new demand curve D2 and supply curve S1. Exchange rate between INR and USD has changed from rupees 55 per dollar to rupees 58 per dollar. Hence, INR has depreciated against USD. Interest rates. Changes in relative interest rates influence international investment activity. Investors flock to the country where interest rates are higher than their home country. Suppose interest rate in India increases from 6% to 8%, while interest rate in US is constant at 4%. Relatively higher interest rate in India induces Indian and foreign investors to make investment in India than in US. To invest in India, foreigners require INR. Hence, higher interest rate in India increases the demand for INR in the foreign exchange market. US based investors buy INR in exchange for USD. As a result, supply of USD in Indian forex market increases. Supply curve for USD in India shifts downward from S1 to S2. Given the demand, increased supply results in depreciation of USD. New exchange rate is determined by the intersection of a new supply curve S2 and demand curve D1. Exchange rate between USD and INR has changed from rupees 55 per dollar to rupees 54 per dollar. Market expectations. Market expectations of future exchange rates also have implications for current exchange rate. This variability in exchange rate occurs when market reacts to various factors including economic factors, social factors, political factors, etc. For instance, if market expects US dollar to depreciate on future due to expected fall in interest rates, that is monetary expansion, they would start selling off their current US dollar holdings, which depresses USD value today. Let us now learn about the introduction of liberalized exchange rate management system in India. On the recommendation of Rangarajan Committee on Balance of Payments, India introduced the liberalized exchange rate management system in March of 1992. It was a dual exchange rate system where both official and market determined exchange rate coexisted. The Reserve Bank of India announced an official exchange rate at which 40% of all current exchange receipts were to be converted, and the remaining 60% could be converted at market determined rates. Official exchange rates used to be lower than market determined exchange rates. All the foreign exchange receipts were to be routed through the RBI via authorized dealers. For instance, if an exporter received 1 million US dollars, he had to convert 400,000 US dollars at official exchange rate announced by RBI and the remaining 600,000 US dollars at market determined exchange rates. This system lasted till February 1993, when it was replaced by Unified Exchange Rate System or the Market Determined Exchange Rate System. Hence, liberalized exchange rate management system was a transitory period reform as India moved from fixed to floating rate regime. In practice, foreign exchange dealers and banks quote two-way rates for a pair of currency: bid rate and ask rate. Bid rate is the rate at which banks and dealers will buy the foreign currency, and ask rate is the rate at which they are willing to sell the foreign currency. Example: a dealer quotes direct quote for USD in India as rupees 52 per dollar as bid rate and rupees 54 per dollar as ask rate. That is, if a person has a dollar and wants to convert it into Indian rupee, he gets rupees 52 for $1 that he sells to the dealer, and if a person wants to buy US dollar, he has to pay the dealer rupees 54 for 1 USD. Now, let us learn how to calculate indirect quote using direct quote. Suppose the direct quote for USD in India is given as rupees 55.0856 per dollar as bid rate and rupees 56.0325 per dollar as ask rate. As stated earlier, indirect quote is the reciprocal of direct quote. It can be computed from direct quote as shown. Thus, indirect bid rate for US dollar is $0.0181 per rupee and indirect ask rate for USD is $0.0178 per rupee. Now, let us learn about the cross rates and how they are calculated. Cross rates are calculated for those pair of currencies for which quotes are not available directly in the foreign exchange market. They are calculated using direct quote of currencies with a common currency. Let us consider an example. A newspaper quotes the following exchange rates. Exchange rate between USD and rupee at rupees 55.0586 per dollar as bid rate and rupees 56.0325 per dollar as ask rate. Exchange rate between USD and Australian dollar as AUD 1.1385 per dollar as bid rate and AUD 1.1401 per USD as ask rate. Assuming that exchange rate between AUD and INR is not available directly, exchange rate between the pair of currency can be computed using the quotation with the common currency, that is USD. For a complete exchange rate quotation, we need both the bid and ask. We are calculating bid rate between AUD and INR, that is the buying rate of AUD in India. The bid rate computation can be easily understood from the point of view of an exporter who has received AUD as his export earnings. The Indian exporter would want to convert AUD into INR, but as direct quote between these two is not available, he first converts AUD into USD and then USD into INR. By conversion, we mean exporter will buy USD in exchange for AUD. The exchange rate applicable to this transaction is the ask rate of USD and AUD given as AUD 1.1401 per USD. This quotation tells that the exporter will get 1 USD in exchange for 1.1401 AUD. Hence, if the exporter has 1 AUD, he receives 1 divided by 1.1401 USD in exchange, that is 0.8771 USD. Now the exporter exchanges this 0.8771 USD for INR using the bid rate between INR and USD. Similarly, ask rate calculation can be understood from the point of view of an Indian importer who needs AUD to pay for imports from Australia. To settle this international trade transaction, Indian importer will have to buy AUD in exchange for rupees. But again, as the quotation between AUD and INR is not available directly, he will have to buy USD first and then exchange or convert USD into AUD. Importer buys USD in exchange for INR. Since he is buying foreign currency, exchange rate applicable is the ask rate between INR and USD, which is rupees 56.0325 per USD. Accordingly, he gets 1 USD in exchange for rupees 56.0325. Now, importer will convert this USD into AUD. At the applicable exchange rate, AUD 1.1385 per USD. By selling 1 USD, importer receives 1.1385 AUD. So if he has to purchase 1 AUD, he needs 1 divided by 1.1385.
Let us now recapitulate what we have learned in this module. In this module, we have learned about the foreign exchange markets and exchange rates. Foreign exchange rate is the price of domestic currency in terms of a foreign currency, for example, INR versus the US dollar or INR versus the euro. A foreign exchange transaction is an agreement between a buyer and a seller for the delivery of a certain amount of one currency at a specified rate in exchange for some other currency. The foreign exchange market provides a platform for settlement of international transactions between different players in the market. Foreign exchange market, which is an over-the-counter market, has two segments, spot and forward. The distinction between the two markets is made on the basis of the time gap between the transaction date and the value date. The foreign exchange market has numerous players in the form of banking and non-banking entities. The exchange rate regime adopted by the country varies along a spectrum with the fixed and flexible as two extremes and a number of combinations in between these two. India moved to a market-based exchange rate system with the LERMS in 1991, followed by a unified exchange rate mechanism in March 1993.